Hey, good evening. It's Dre Briggs with Obsidian Wisdom. And today we're going to build a retirement plan from the ground up. Now, this one I'm going to use a whiteboard. I'm going to create the plan with you. I'm going to walk you through the 5 parts of the wealth of retirement system. And you can build your own retirement plan this way, or I can build it for you. Now, I'm sorry for it taking a little bit of time for me to get on. I could not get my actual good camera to work. I just was like, you know what? It just is what it is. The good camera is just not going to work today, Dre. So we ended up just saying, let's just get the show on the road, right? If something electronic can kind of go wrong, sometimes it just goes wrong. But that's okay. We've been doing this for a while, so we're not going to worry about it too much at all. So I had this interesting conversation. It was a business owner, they were partners, and they were in their 40s and they didn't have anything set up for their retirement plan. They were generating a lot of revenue for their business and they just wanted to know what they should do with their money. So I'm going to walk you through what would basically be the 5 parts of the wealth of retirement system, and that will give us the ability to say, all right, I know what type of things we should check off on any retirement plan that will help us feel pretty good about the overall future. So the first thing that we'll always look at, and I'll add these to the whiteboards for you, is let's give you some of the information. So we'll give them just some pretty simple names. We'll say that they are Sarah and James. Oh, I need to change this. Perfect. So we'll say they're Sarah and James. They're both about 40 years old. The revenue generates about a million a year. They expect that to be increasing. For their net profits, we're having it about 300K. And then the salary is like a clean 100K, just to make the math nice and easy for me. And what we are starting with is a good old $0. So we have nothing that's set aside for retirement. And then we'll basically go through each of the aspects. They have, let's say, they have about 200K in home equity. And then as far as the business, we were saying about 10 to 15 years. No one would be mad if it was 20 years, but we're wanting to see what's possible in 10 to 15. And then if we need to go to 20 to 25, that's equally fine, right? They enjoy the work that they're doing. They're not 100% sure how long that opportunity is going to maintain itself. And we just want to say, hey, what would it even look like? What would it look like? And so what I normally do, and I normally will use my financial calculator for you, but what I'll do today is I'm actually going to pull up just a financial calculator online, and I'll show you just kind of how to put the numbers in and how to be able to just overall read a financial calculator. So I'm going to share that screen with you. So this is just calculator.net. You can see it has a financial calculator, and there are 4 inputs that you get, and the fifth one is what it solves for. And so that's kind of what you're looking at right now. And so let me zoom it in just a little bit for you. So it's a little bit cleaner. And so you can see it talks about a BA2 plus. That's actually the kind that I have. And so what you'll do is the N is the number of years. And so at the top of the calculator, you normally see that. So we're going to say, we'll say 15 years. The interest rate, whatever the investments are, we'll say, hey, what's the average return? If you're like, hey, I think I'm going to be able to maintain what the normal stock market return is, we'll say, okay, well, that's somewhere between 8 to 10%. So we'll say 9% is what the return is. If you are someone that's saying, hey, I'm going to be a little bit more conservative, then you would choose a more conservative number. And you say, all right, that's great. Then we would say, how much do we currently have set aside? And what is in the account right now? And in the account right now, the present value is $0. And then where it comes into play is you would either have to know one of the last two things. You either have to know what the amount that you want in the future to be, or you would need to know how much you're willing to invest every single year into this retirement account. And based off of that, we can then solve for the other one. So based off of that, let's say, so the business has about 300K. So let's say that they're going to be able to, if we had a solo 401K, I believe it's at 69,000. So we'll just say 70,000, make my life easy. You also have the option of adding what's called a cash balance plan. It's kind of a combination between a pension and a normal retirement 401k plan. And it's a nice little bonus feature where you can save some taxes in the present time and you can have more money that you allocate towards your retirement plan. I'll show you what that looks like. But so we'll go ahead and we'll solve for that. If someone was to 15 years, generate a 9% return with no money today, and they're willing to put $70,000 every single year into that plan, which is basically maxing out your 401k, as you can see, you would have a future value of $2 million, right? Like that's what it would estimate. And then what did you put in? Well, I'm glad that you asked. You contributed, zoom in a little bit, you contributed a little over $1 million, and then it generated a little over $1 million. So half of this money was money that you put in, half of the money is what your retirement account put in. Now that one of the benefits that we ultimately receive is, and you see it when you're willing to go a little bit longer on the investments, then it's less of our money and it's more of the money working for us. So you can see that when we added just 10 years, so we went from 15 to 25 years, you can see that it over doubled the amount that was in the account. We had $2 million where we had to put in 1 million and it generated 1 million. Well, in an additional 10 years, the only thing that we actually added was another $750,000. We did not even put in another $1 million. But you can see that just adding another 10 years of investments generated an actual double the investment. We have $2.2 million now. So we have $4.2 million total in the account. Or actually, we have $6 million total in the account. Yeah, 4.2 million is what your investments generated. So went from, on the 15 years, and I'll go back, it went from me investing $1 million and my investments generating $1 million, that was over 15 years, to 25 years. It went from my investments only generating $1 million to my investments generating an additional $3 million. So I have now $4.2 million from my money working for me, which is obviously a very nice situation to be in. The reason I show you this, and even when you go to 20 years, is it matters at the end, right? So we had 15 years, we put in $1 million, $1 million was generated. We waited 5 more years, put in an additional $400,000, and yet we have another $1 million in our investments. And sometimes that's why it's very important when we're talking about the returns on your investments. It's not that there's a certain amount that you need to put in, because it could be, but depending on the investments and how long before you need to touch the money, that can dictate how much you have in the account. And you can see that just an additional 5 years, and I've shown you all in many different times, when you look at the stock of any company, you will see that that's basically the magic of compounding interest. And as Albert Einstein said, compounding interest works for us or it works against us. And we find that to be true over and over again. So if compounding interest is working for you, so we'll pull up the Apple stock real quick. I'll just use a simple example. So you can see that Apple has been around since 1985, good year, 1985, and you see that they have been pretty much doing nothing. Even, I won't say nothing, right? That's kind of ridiculous, right? They've been doing a lot, but you can see that a lot of the growth, the compounding interest, has happened within the last 15 years. Now you can see that even when the iPhone was invented, even when the iPad was invented, we're talking about in the early 2000s, we could have at that moment been like, this company has figured something out. I'm going to buy those stocks. And we would have bought them for like $6 a share. We'd have bought them for like $4 a share. We would have been like, hey, I think that this is a good company. We're not even gambling. We've seen it. This company is phenomenal. They're going to change the way that we talk on cell phones. And you could have gotten it at $3 a share. And less than 20 years later, just at the end, you can start saying, okay, now it's over $1 trillion company. Multi-trillion dollars actually, but you get the idea that this growth has been exponentially over the latter decade. It's been around for about 40 years, the first 20 years, and the last 20 years is a big difference. Your retirement works that same way, that if you give your money time to grow, once you put the money in, great. Even if you stopped investing it, you can see that the money is compounding and it's going to grow for you. So if you are someone that's starting at zero and you have 15 to 20 years, it's definitely doable for you to be able to achieve those numbers. You can just see that just by simply doing the math calculation. And that's what I would do. So now if you had a different number where you said, you know what, Dre, I don't know how much I need as far as my payment. I just know how much I want to have at retirement. Then you would go on to the payment tab, right? So this is solving for future value. This one is solving for payment. This is solving for interest rate. This is years, and this is present value, how much you put in. If you're going to use present value, more times than not, that would be like someone that was like, hey, Dre, I want to be able to put some money aside for my kids' college, right? So they were just born and they're going to go to college 18 years. How, what is the average amount that college ends up being? How much do I need to put in right now? And then we can solve it out. Another situation that you would want to know the present value is if you are, so in Florida, we have the Florida retirement system, we have what's called the drop program. You can take like a large sum of money right away, or you can have this pension fund, and then you have the certain amount that's spread out over your lifetime. And you were saying, well, Dre, I need to know if I was able to get the money today, what that would look like. Like, how could I have a certain income? How much money would I need to have today? And then we would do basically the same thing. If you wanted to be able to solve for the payment, then we would say, all right, we have a present value of $0. We want the money in 20 years, 9% interest rate, and then the future value. So we would right. So we would say, I want to have $5 million. Cool. Right. And so if you want to have $5 million in 20 years with a 9% interest rate and you have $0 set aside, as you can see, that means you would need to contribute $97,000 every single year. So about $100,000. And then that would have you contributing about 1.9 million. And then your money would grow the other 3 million. And then it does go as far as if you're, super interested, it does break it down as far as the calculations for it. And then it just goes through what that amount will look like every single year. So it gives you an amortization of it. And like I said, I use these all the time. If you are sitting with me, we're having a meeting, you just ask me a question, you need to know what a number is, I can tell you. You can say, hey, Dre, how realistic is it for me to have $5 million in, we'll say in 15 years, and I'm going to be able to contribute $100,000 a year? I'll say, all right, I'm glad you asked me. So then I would say, all right, 15 years, $100,000, $5 million. Let's see how reasonable that is. You would need a 15% return on your investments on average. That there's going to be years that we can have more than that, years we can have less than that, but we need to have about a 15% return on average. And then I would say, hey, this is what that type of portfolio will look like. Is that something that you're comfortable with? Because we can go for it, but we have to recognize that the more risk, the more opportunity we have for growth, but also the more opportunity we have for loss. How do you feel about that? And people are like, all right, well, I don't think I want to do that. All right, cool. Then it's not very realistic, right? You get what I'm saying? All right, so it's not very realistic. So then we'll move on from there. So just starting with that, as far as the number, what do I do with my little pin? I know I had it. There it is. All right, found my pin. So that would be basically the first place that we would say, all right, based on just the numbers and what we're thinking, this is kind of what we can do, and then we'll build the plan from there. So based on that, we can say, all right, based on the timeline, the amount of money that you have, the amount of money that you plan on generating, we can put a plan together to have millions of dollars set aside for retirement, right? We just did like a little quick sanity check. So then we would move on from there. So normally there is 5 parts of the wealthy retirement system. All right, so I will place these here for you. So number 1 is we got to have the tax smart strategies. And then I normally couple that with the estate plan. All right, so if we're crushing it, you have all this money, we might as well figure out what we want to do with the money afterwards. If we don't do nothing, Uncle Sam's just going to take it from us. And most people don't want Uncle Sam to take the extra money. So we got to figure it out. Even if we wanted to leave it in your favorite poodle's name, that at least we have the ability for you to decide what happens to the money. Now, we don't need to leave it in your favorite poodle's name, but at least you have the option. Number 2 is we would normally then talk about our wise financial the guidance, and I have a framework for this. And what we do is we basically start looking at the risk to us achieving the plan, right? So we just started with the first part. You have the number. Cool. I know how much money I need. I know how much I need to invest, and I know how long it needs to be invested. But what if everything doesn't go according to plan? And normally that's where the wise financial guidance comes in. How do we protect ourselves against risk? What do we do with the recession? Because you're going to have at least one every single, decade at a minimum. And in case of those that are wondering, as far as the technical definition, we're halfway to a recession, right? A recession is normally 2 quarters of economic loss. I'm not breaking news to tell you that January, February, March was a down quarter. So we're kind of in the middle of on our way to possibly having another quarter. And if we do, then we would be in the definition of a recession. Now, it doesn't mean you feel like you're in one. It doesn't mean that you believe it. We're just simply saying, economically speaking, if you have 2 quarters of economic loss, GDP decrease, et cetera, then you're in a recession. So we're halfway there. So what do we do to make sure that we don't make any bad decisions? And what do we do to make sure that we protect ourselves? The one that I find is often overlooked is the healthcare. I think I actually did that wrong. There we go. Fix that. All right. So we have our prosperity healthcare blueprint. And we talk about what that looks like, everything from your HSA plan, if that's available, to the type of Medicare that you would choose, to Social Security. Everything goes into the healthcare plan. And then obviously just your overall health. Because as we mentioned before, when I talked about when to take out Social Security, it depends a lot on your health and your spouse. And there's so many moving pieces. So we normally will talk about that. Then we touch on what we've already started introducing with. Most people like to start with the investment. So that's why we normally will start there. But then we have what I would call our investment resilience. So we have our income and investment resilience. The investments, that's great, right? We say, hey, I want to have a few $1 million, great. But what is the monthly income that you want to receive, right? That to me is the guiding light. Because I could take that money and invest in real estate and generate a certain income. I can take that money and invest it back in the business and we can generate a certain income. We can take that money and invest it in the stock market and generate a certain income. But the amount of the money depends on the income that we need and the strategies that we have. And so we'll normally talk about that. And then the goal, anytime you're investing for your money, is to make sure you don't run out of it. So hopefully that makes sense. And then the last one, and it ends up actually being my personal favorite, it's where I would say I have the most value add. Now, I know that because my mind works this way, it makes investing and understanding the economics of finances easy for me, right? Because my mind works that way. At the same time, I recognize that some of you may be chemists and I would just crumble. I would crumble trying to understand chemistry. My mind doesn't work that way. And so for me, because of the way my mind works, these are the things that it's almost hard for me because in my mind, I'm like, look, this is easy. Anybody could do it. But I recognize that it's the way my mind works, so it works for me. But I enjoy talking about what we do with the money. And so that's why we talk about your purposeful lifestyle transition. Now, a lot of the time, the thought is, oh, of course, Dre, once I have all the money, I'm going to be happy, duh. And we both know that that's not the case. We know that it's not a slam dunk, that you don't just wake up happy because you have a whole bunch of money in the account, that your happiness is tied to how you spend your time. Number one, how you spend your time. All right, so let's go through each of these for this particular business owner, and then we'll get the action steps and we'll go through each of the pieces. So when you go through the first one in the tax smart strategies, right? So we talk about tax smart strategies. Because they're two business owners, we would actually consider just setting up a solo 401k. If all of your money is considered after tax, this one gives us access to pre-tax, so you can reduce your taxable income today, and then you do pay ordinary income. That's what the OI is, ordinary income tax in retirement. You set this up between you and a business owner. The thing I like about this is you also can add a Roth component to it, to where now you have the option of placing the money inside of your Roth portion or inside of your 401k, traditional 401k portion. And then they're both under 50, so they don't have the catch-up provision, right? So we have 69,000 that we can place in there. And then it is, I believe it is 23,500 as an employee. And then you would have the rest of it being contributed as the employer. So that would be company matches and all that fun stuff, right? So that would be the employer. You have the extra benefit of being a business owner where you contribute as the employee and the employer. You get to wear both hats in your retirement plan. So you get to say, hey, we're going to contribute 23,500 as the employee, And then you get to turn around and say, great job, employee. I'm going to match that. And I'm going to give you your bonus for a great year. And you're going to, reward yourself as the employer to the employee. So that's fine. You get to do that. Now, for those of you that are in the 50 plus category, you do get the extra bonus of contributing an extra 7,500. And then we also added, when you get to 60, you have the super contribution, where they added that kind of recently as well. So this is normally going to be the one that we would set up if you're just a two-person operation. If you're someone that has a staff and you generate a pretty consistent income, we can definitely set up a traditional 401k. Heck, we can set up a traditional pension plan, and you can have a pension that's set up. It just takes a lot more cash flow, because you do have to allocate a certain amount of money to maintain whatever the actuaries say that you need to maintain for your retirement accounts as far as the pensions, which is why a lot of people don't like starting there. But you do get to contribute more, and then that also helps you as far as lowering your taxable income, and it gives you a sexier option to attract great talent. So you do have those options available to you. And then some of those, so one of those could be like a SEP, and then that would be something that you can contribute yourself. And then I do also like the cash balance plan. You are allowed to contribute that as well, and you can combine it. So we could put like 100K in the cash balance plan. You could put 69K in your individual one. And then you had, I think we said we had like 300,000 that was sitting there. Well, now you've set yourself up in a way that you have basically half of your taxable income is now contributed to your retirement plans, which again gives you a little bit more flexibility. Uncle Sam can't be mad at you. He encourages you to do that. And then when we talk about estate planning, we normally like to start with it kind of simple. So when I say simple, first we're going to just start with wills in place. If you're a business owner, we probably would consider a buy-sell agreement between, if you have partners. And then if you want to have any, for me, I would normally also consider, especially if you have children, some sort of trust options. Now, there are lots of trusts, and I have a future video I'll put together where I go through a handful of the trusts. But high level, there's really two main choices. You have an irrevocable, I think that's it, and revocable. With the big difference of an irrevocable is it's gone, it's gone. Like it's gone. It does not belong, belong to you anymore. And this one you can change your mind. So when we talk about revocable trust, normally when we're talking about your ability to change your mind, this is going to be a living trust for most people. I just kind of like to clean everything up, place everything in this trust, have some rules that are set there. It's okay that Uncle Sam considers it still mine, because I have the ability to control it. I can take the money back if I wanted to. I can take the property back if I wanted to. So Uncle Sam it still counts in my estate, right? So that's kind of the big thing. If your goal is to make sure it doesn't count in your estate and you're trying to lower your taxable estate, then you're going to want to explore an irrevocable trust, because now you don't have access to it. It doesn't belong to you. It belongs to the trust. If you have access and are able to control it, Uncle Sam said, look, you're just trying to put one over on me. I'm not listening to you. That still counts in your estate. Some people have different goals. So depending on what your goals are is how you would decide that. But you do have, and it's currently set, I believe it's like 13 million. That is the amount that doesn't have to be a death tax. So anything under that, you wouldn't have to worry about it. So we would normally, that would be the first portion. So they say, hey, look, we need to go ahead. We need to put some strategies in place that allow us to limit the taxes. You don't have anything for your retirement plan. We know what the amount is that we want to have. We can lower some of your taxes today. We can start putting the money inside of a Roth today. You don't traditionally have the ability to just open up your own individual one, but inside of this solo 401k, you have the ability to do it. How does that sound? That's all right, cool. I can live with that. So then you would move on to, and hopefully this is making sense for you. And then we'll move on to number 2. And right, so number 2 is the wise financial guidance. So anytime you're a business owner, we almost always, man, that's some rough handwriting. We almost always want to start with getting a business valuation. And you want to normally do that every 3 to 5 years. It's not that planning to sell the business to fund your retirement isn't a plausible or reasonable idea. It's just that we are limiting flexibility. You guys know that I'm big on flexibility. I like having options. Just having that as my one plan, I don't know if that's going to be feasible. But if that is the plan, the minimum that we could do is get the valuation every 3 to 5 years. Normally, if we find a good one, they will give us some things that we can do to fix it. I can tell you high level the things I see all the time. All right, is naturally is like how well the books are kept, how active you have to be in the business. Like if you left, does the business die? Because a lot of people that want to buy the business, they don't want to actively buy a job. Like they're not buying your business to have a job. So you want to be able to have the systems in place that you can transition over to them. You want to have the key employees in place that can run it and you can show that you were gone for 3 months and the business kept going. There's a lot of businesses that in 3 months they just crumbled. And so then obviously you're paying your paying your taxes, or you're claiming the income, or you're doing all the normal stuff that we would look for in the business. I only laugh because of you can imagine some of the stories that you can end up seeing where you're like, oh really, that's what we did. Okay, oh I don't know if that's how that works, but so normally things like that, which normally leads me to always encouraging them to do diversification. Now you guys know I'm big on having at least 3 streams of income. So the IRS says that if you have 3 streams, well, not the IRS. IRS recognizes 7 streams, but the studies say that 65% of self-made millionaires have at least 3 streams of income. So for me, that normally is a good balancing approach. So when you're looking at the 7 streams that the IRS says that they recognize, you will see that we have our normal income, right? So we'll say earned income. That's you and me working. We'll have royalty income. I probably created something amazing. I licensed it, and through the license, I make the money. And so that could be a book. License the book, you just make the money. You can license music, put it on Spotify, anything like that. Just I created something once, I license it, I make the money. If you're interested in real estate, you can have rental income. If you have a business and you rent out equipment, like you have dump truck equipment that you want to rent to the city, you could have rental income that way as well. But for most people, it's going to be your real estate. You can have capital gains. So that is anytime you sell a stock that has been around for at least been in your portfolio for a year and a day. If it's under that, it's just ordinary income, it's earned income. But if you have it for a year and a day, then you have that benefit. You also have interest. You can think of interest anytime that you've had and you can remember, right? So when you end up in your bank account and you see at the end of the year they place a few bucks in there, that's the interest that you earn. So if you buy bonds and other debt, that is the interest that you earn. Okay, so we have 6. You have investment income, which we normally call capital gains. Oh, no, sorry, not capital gains, which you normally call dividend income. So your investment income is your dividend income that you normally see in the investments. If you're someone that's allocating investments in a way and you're focusing on having this income stream for the rest of your life, a lot of people are very focused on having a solid amount of income streams for the rest of their life. And you're saying, well, all right, Dre, if that's what I want to do, how do I accomplish that? I'm like, hey, I'm glad that you asked. If you want to accomplish that, you buy stocks that pay out a dividend. Now, the stock market on average pays about a 2.5% dividend. And it is because of that, it just changes how much money that you need to have invested inside of it. But it doesn't mean it's impossible. It doesn't mean that you couldn't find something that pays a higher dividend. Then you wouldn't have to worry about that, going forward. So you'd be in a good spot. And then the last one would be profits from a business. All right. So, all right, let me slide over what. Right, and so that's what you have. You have your business. So those are the 7 streams of income. We normally choose the 3 that make the most sense for us. As someone who specializes in stocks, I'm someone who spends a decent amount of time learning and understanding everything from your capital gains to your interest to your investments. I do spend a decent amount of time with my clients helping them with the business because it's their business and I run a business as well. When we talk about rental income, I can tell you the math of it. I can tell you if it makes financial sense based on the numbers that you give me. But as far as going around looking at the properties and finding them, that one wouldn't be normally within my scope, right? So that's not in my scope. For most of us, we like to start with earned income. And then from earned income, we normally spread our wealth and we start building these other streams. Whether we want to invest the money in a business, whether you want to invest that money in real estate, or whether you want to invest that money in the stock market. I like the stock market because it gives me access to all 6 streams of income outside earned active income, that I can invest in stocks where they have royalty income generated, right? Like I could invest in Disney. They have a lot of royalty income streams. I can invest in rental property. There's REITs that are out there that are paying rental income, and I get to claim it as such. Anything that I'm investing in the stock market over a year and a day is capital gains. Interest income, I can invest in bonds. Dividend income, I can invest in dividend companies. And then I essentially get to share in the profits as a silent business partner. That's what you are as a stockholder. And so normally that is going to be the reason I prefer the stocks, but everybody has a preference. Everybody has something that they want, that's their wheelhouse. If you're a real estate agent, then it's like, hey, look, if you're a real estate agent and you build houses, you do this stuff, you know that, then let's build the streams through these properties. You could have a variety of different income streams from your rental properties, and you can have a business and you can have offices, all of that stuff. And so we normally will say what makes the most sense for you. And then if you just say, hey, Dre, whatever makes the most sense for you, that is normally where I lend myself towards. And then the third one that we normally look at, and it really is a case by case, because I don't think everyone needs one, but it depends. To me, it depends on your risk tolerance, and that is your emergency funds. Because if you have the money sitting in cash, normally what we'll do is we'll have your 3 bucket strategy. It's just like 3 boxes, I know, but it's your 3 bucket. So you have your safe, you have your moderate, and you have your aggressive. So my aggressive is basically going to be my, right, so my stocks, my business, and my real estate, right? Just to keep it simple. My moderate, my moderate is normally going to be, we'll just say our bonds. We can maybe say some balanced funds. And if you have any sort of like an annuity. And then your safe is going to be your cash or cash equivalents. So anything that you can sort of touch in a short amount of time. So because I have my safe, to me, that is what the emergency fund is for most people. It's just whatever the amount of money that I'm not leaving invested. So that way, if the market has a correction, I don't have to take my money out during the correction. I can wait out the correction. To me, that's what the emergency fund is. I think of it as my living expenses. Now, I do see, and sometimes there are situations where we will put a little bit more. So this is normally 1 to 2 years. This is normally around the five-ish, and this is normally going to be somewhere around the 10+ years as far as. And so you take the money, and over the time that your stocks are doing well over 10 years, you sell them into this one. Over the time that you have good opportunities to sell them, you get the cash and cash equivalents, and then you just spend this down. And then when you're going through something like 2025 as a recession, you're not selling these, you're probably not selling these, and then you're just living off of this, waiting for the correction to finish. And then as a result, when the correction happens, then you're saying, okay, now the market's going back up, and then I sell, and then I sell and I replenish. But you give yourself a couple years. Now, when I have people that are working in real estate and they have these other investment opportunities where they're like, look, Dre, I'm not really concerned as far as my risk. I just want it to be more like an opportunity fund. And I'm like, no problem. So if you want to have this as an opportunity fund, you can have your 1 to 2 years, and then you can still have, and you'll see like Warren Buffett and other investors do that. They'll have a lot of money sitting in cash waiting for the sale, where they're like, hey, if there's going to be a recession, there's going to be a correction, if things are going to go on sale because markets are tanking, I want to have some money set aside so that I can buy this stuff on sale. Now, this has a lot to do with obviously your risk tolerance. Everybody's not going to be comfortable or interested in doing that, but that's right. That's the overall idea. That's why we go through setting up what the actual plans are so we can ensure that you protect your money. All right, so we have the third one, which is our healthcare. So if we're making it to 65, then we're probably going to be talking about Medicare. And then whether or not you have the certainty and you're traveling, we'll decide whether we need to explore the Medigap or the Advantage, which you may see as Medicare Part C. So the thing that people like about the Advantage is it has dental and vision included. It's not doing it. Let me scroll down and see if that's going to help it. Oh, it says I have reached my limit. Oh, that's what it was. All right, let me go back and let me just delete a couple of them. So you already seen it, so you're good. Because at first I was like, what is it? Like, what is it saying? Now I get it. So let me go ahead and let's remove those. Okay. So now we keep going. All right, we must be right. We're working hard today. We're working hard today. So it's like, look, this is too much stuff for me to keep track of. No problem. So normally your Medicare Advantage has your dental and your vision. The thing that people like about the Medigap plan is it normally puts caps on your copays and your out of pocket. If you're looking for a little bit of certainty on the expenses, it normally covers that. And then sometimes it covers a little bit more than the traditional Part A and Part B. And then you have the D, you can add that with any of them where you have your prescription drug. And so then normally you'll say, all right, based on whether I'm going to be in a network like a Medicare Advantage, then if I'm traveling a lot, this may not work for me because I'm not going to be around my network. So I'm going to be paying these higher out of pocket expenses. The Medigap will give you some of those options, but then they have the table and you get to choose which one makes the most sense for you. Most people choose the N. I think as most people choose the N. Let me double check. Let me just look at it and I'll show you real quick. So it was G. Oh, it's close. I think it's yeah. All right. So the Medicare. So G is the one that people choose the most of. Let me see if I can get the image of it, and then I'll be able to show it to you. Okay. Right. Why is it so tiny? I don't know why it's so tiny. All right. There we go. Okay. So just looking at it, you can see why most people, right, I'm not endorsing them. I just found the first one online, just so you know. But you can see why most people end up choosing G. It covers everything. So you just have less to think about. And then when you go through these websites, they'll tell you what the prices are for these different plans. And I know I did a video a while back and I just need to do another one. But when I went through it on the video, it really came down to us choosing between, I think it was like G and it was, who was the other one? I think it was, no, not that one. I think maybe G and F. I can't remember. I can't remember which one it was. But G is the most common one. So why is that? You can see it says Medicare Part A, your coinsurance costs up to an additional 365 days, right? It's covered. So I have that. All of them have that. Your Part B, your copay and coinsurance coverage, right? So we have the caps on that. So you're like, man, that's great. And then you have your first 3 pints of blood, right? That's covered through all of them. And then you'd have to pay like 50% of it or 75% of it, depending on those plans. And then you have your hospice care for Part A, your coinsurance, right? It's covered. We're good to go. My skilled nursing facility, you can see that A and B do not cover this one, but then C through G do. And then my deductible, where my deductible is taken care of, boom. My deductible is taken care of for Part A. My deductible for Part B, that one is not covered under G. But it would have been, it is covered under F if you just want to be able to have that. But for most of the time, if you start looking at the deductible and how much you'd have, like the difference of the fee would be, for most people, that's why they choose G, because I think I would just rather pay the deductible than pay what essentially amounts to more than that to have that covered. And then you look at the Medicare Part B excess charge. The excess charge, I believe it's like after like 100 days or whatever the amount is, there's a set amount that you're allowed to spend that you cover inside your Medicare Part B. And then anything over that ends up being something that you have to pay out of pocket. So if your provider bills you more, it's not super common because most Medicare providers understand that they're just going to charge what the Medicare rate is. But you should be mindful that they are out there. And there are some that will charge you more than what the Medicare Part B will cover. And then it's whether or not you'd have to pay that. And you see under G, they're going to give you a little bit more protection. And then your foreign travel, you see that they'll pay 80%. 80% of it is covered. So it puts you in a good spot versus having the advantage where if you're traveling, you're going to be paying a little bit more, right? So that's kind of what we're talking about with the Medigap. So we go through that. That is just the mathematical side of it. But then we also have to talk about the lifestyle side of it. the family history, how long everybody's kind of living, how we're living, normal situations. Do we want to do we want to walk and eat healthy and all these other things? We normally would put all of those pieces together when you're talking about your prosperity healthcare plan. And then for this particular business owner, what I almost always, when you're in your 40s and you're making that amount of money, we will normally say, hey, what about disability? Do you have disability insurance? Are you all protected against, you just not, right? We have life insurance a lot of the time. And most of us know that. Hey, what happens if I die too soon? All right, life insurance. What happens if I don't die too soon? I just become disabled, that I'm unable to maintain the normal operations. So I'm a brain, right? Like you saw the movie with Doctor Strange, right? So he is a amazing doctor, a surgeon, and his hands are shaking, right? So he can't be a surgeon anymore. So you have life insurance, which is great, but you didn't die. You just have this inability to be a surgeon anymore. Now he could have another job, but he wouldn't be paid as much as being the brain surgeon or whatever the surgeries that he did is. So do you have disability insurance to cover that gap? And for a lot of business owners, your skill set is so unique that it makes sense for you to have that protection, to be able to add that layer of protection. So then the fourth one, and hopefully this is making sense to you. If you have any questions, I'm going to look back in a moment, and hopefully it's going well. If it is, then I appreciate you just liking and let me know. So then the fourth one is we're going to talk about the income. So we had already done the calculation. So we're going to say, well, I wanted to have about 3 million bucks. We remember that we looked at it even for 5 million if we're able to wait for 20 years. And then you remember we had looked at it. We said, hey, if I want $5 million, I was able to, right? I think we did this payment now. Yeah, so my future value. So I want to be able to say, hey, I think it was like 15 years is what we ended up doing. And then, yeah, that was 3 million. So I think we waited 20 years, right? So it's 20 years. That was 5 million. Yep. So 20 years, 9% return, no money down today, but we're going to pay $100,000 every single year into this fund. What would that give me as a return? And we said, hey, that would give us the 5 million bucks. So we would say the income plan would be 5 million bucks in 20 years. And then when you're talking about the withdrawal rate, so normally most people will start somewhere around like a 4%. If you're starting off with a 4%, I believe that would be, so 1,040,000, so that's 200,000. Well, you don't need 200. You probably don't need 200,000 because that's not what we're spending now. But the 4% rule of 5 million would give you the ability to take out $200,000 and you have no concerns, right? So most people, that's probably not going to be what you need. We would then build the allocation that we need if we're going to have a 9% return on our investments. And I will show you some of the model portfolios that we'll commonly use. And so I like to use the websites that you all can see, because obviously if I can go into my stuff, which that gives you no value, because you don't have the access in all the different fancy stuff that I have. So I normally would go to a nice simple website like Portfolio Charts. And so this is one of those allocations that could be one that you would use. You can see that we're protected in a variety of markets. So in this current market, you would have said small caps, large caps are probably taking a hit, but then your gold and your bonds are doing a little bit better. And so that's all we're looking for when we're allocating. We're looking for the ability to have some wins and some losses. Now, I know Ray Dalio's, this one is probably is generally high level. It's a little bit on the conservative side to be 40. But he has 30% in the domestic stocks, 40% in long-term bonds, but see another 15% in intermediate bonds. And then he has commodities and gold. So, that's normally, he's a macro investor, so that's not surprising as well. And then you would have that as your allocation, and then you would work through that portfolio. You would rebalance once a year, once every couple of years, to make sure that you're just performing and maintaining your overall allocations. And then we can get as aggressive or we can be as conservative as you want. There are so many allocations that you can put together. So this one is going to generate about a 5% return, and then you have a 75% of the time you'll make money, 25% of the time you won't make money, right? And so that's what we're talking about when we're building these asset allocations. So we would choose one that would work for them, depending on how active or how passive they wanted me to be, or how active they want to be, right? So if you're doing it on your own, are you someone that wants to check this every single month? Because if you do like checking stocks every single month, then you can have an actively managed fund and you can just see how they're doing. If you have to day trade, then you're probably doing it wrong. That there when you're paying the fees by the time you finish all the day trading, it doesn't the math just doesn't work out for most people, right? The math just it just doesn't work out for most people. So that's why normally what will ultimately be doing is you normally pick something that you have to touch often, but once a month at the most. That if we need to go any more than that, then we probably are a little bit too aggressive for a retirement fund, and then we'll just kind of ride the waves of the overall market. But let me show you a few more model portfolios so you can see what that would look like. All right. So we're talking about most aggressive. For most people, you're going to be on your most aggressive end. You'll probably be at 80% in equities and 20% fixed. But it doesn't mean that it's impossible to not be even more aggressive. And there are some people who will balance it out, where your business has a certain amount of the aggressive in it because your business is giving you a significant return on your money. And then we can have the investments in the stocks to be more conservative to give you that balanced portfolio when you match them all together. So this one, we're about half in equities, we're about 25, or about a quarter in international markets, and still another 10% in emerging markets, like places that are up and coming. If you're able to find the next Amazon, is kind of the idea, then you're normally positioned to ride that wave. And then you have the rest is going to be normally hedges. So you have your bonds and you have your real estate to try to offset some of the risk, but you have nothing in cash because you're like, I don't need my money to be liquid. I'm not going to touch it for a while. And then you can see that the aggressive is more like the 80-20. There's still nothing in cash, right? The idea is, why would I have something sitting in cash if I'm not going to touch it for decades? And so obviously that could be an allocation for you. And you can see that we're still around 50% in equities. We still have about 20% in international, 8% in emerging, and then we've increased how much we have in the bonds, international bonds. And then you can kind of keep going. So growth is 70-30 is kind of where a lot of people normally end up liking to be. You give yourself a little bit of a hedge against some of the loss. We're now combined between the two of these. We're slightly over 50%, like 60% is in the equities. And then we still have a little bit in emerging markets to give us some of those opportunities. And then the rest of it is hedging. So we have almost 25% of it in some sort of protective hedging environment. And so you can have a variety of these, and we have different goals. So there's sometimes they'll say, hey, it's all about the income, and we can put a strategy together that's all about the income. That we're finding a bunch of cash-rich businesses, and then we're investing in them because the income that they give out in dividends and different things is what you're looking for. It always the investments is not that you can or can't. It's just, hey, what is the goal that we want to accomplish, and from there we ultimately will. And so you can see that oftentimes the money part is the easy part. We have to figure out what the goals are. We have to figure out the timeline, what the investments are, the return that we need on average, how much risk we can take. And then we protect ourselves from these, protect ourselves from the recessions, protect ourselves from possible disabilities, protect ourselves from all life events. Like you have another baby, our spouse could pass early, you have divorces. There's a lot of life events that happen along the way in a span of 20 years that changes the plan significantly. So hopefully that makes sense. Is this making sense? Is this making sense to you all? Hopefully it is, right? So if it's making sense, give me a thumbs up. All right, so then the very last one and part of the wealthy retirement plan is going to be the purposeful. I probably have to erase some of these because I know it's going to tell me that it's too much. So let's just go ahead and erase that. We'll do that right now. And so the very last one has to do with the lifestyle. So what does a fun day look like in retirement? What do I want to do with my time? Where do I want to go? Who do I want to meet? All of those amazing things. The first thing, if you're a business owner, that we normally will start talking about is, what is the exit strategy? The good news is we've been doing evaluations every 3 to 5 years. We've been getting the feedback, making small tweaks to the company. We've been investing so that we have protection, that if the company wants to go belly up, we have other investments. We've diversified so that even if someone did something dumb. So I remember there was, normally you have that protection, right? So even I, giving advice, I have E&O insurance, errors and omissions, and just like a doctor has malpractice insurance. So hopefully you have that protection inside of your company. But let's say just something crazy happened and you end up losing your company, and that was the entire retirement plan. Well, now we've been taking some of the wins from the fund, from the business, So now you have something set off on the side, right? You have actual wealth that is tangible and ready for you to be able to take advantage of. But we do want to talk about the exit strategy. And so when you talk about your exit strategy, how are we selling it? Are we trying to sell it to the employees? Are we going to IPO it? Are we going to sell it to some third party? Are we going to give it to our children? Are they interested? Have they been involved? Like, how do we want to be able to sell this business? What is the strategy? How are we getting paid? How are we evaluating the company? Do you want to be someone that's a consultant that works for another year or two? Do you just want to get the money and run? Like, how do you want to set up the exit? And that's really what it comes down to. We want to be able to think through this, plan on this, because we want to make sure we enjoy the experience. You don't want to be like, man, that was really tough. I don't want to ever do that again. We don't want it to be that kind of an experience. We want it to be like, yeah, that was pretty good, right? I enjoyed that experience. Also, spoiler alert, if you spend a little bit of time preparing for it, it makes it less likely you have cold feet. We're like, no, my business is my baby. I don't want to sell it. Because that does happen. People are like, I don't think I want to sell my business anymore. You're like, oh, okay. Well, I mean, it's your business. You don't have to. But if we're able to have the plan in place and we talk about it, then we can kind of go from there. And so once you sell your business, then we move on to the goals of your time. So when you talk about your time, I normally have this thing called the beginning of happiness. It's like different aspects of your life, and it's different things. So we can talk about our romance, like we measure how we feel about that. You can measure how you feel about, I normally would say, like your contribution. Like, do you want to volunteer? Do you want to give back? Do you feel pretty good already? We can talk about family. Do you enjoy spending the time with them? Do you want to move to a mountain where they never can find you? What do you want to do? Do you spend too much time or not enough time with them? We normally talk about finances because the finances do play a role. We normally talk about spirituality, whether that is religion, whether that is meditation, whatever kind of that looks like. We talk about spirituality, balance, just how you feel as a human being and fun stuff like that. We do normally talk about leisure, just what do you want to do for fun? Do you want to travel? Do you want to start another company? Because that does happen. People are like, Dre, I think I'm ready to start a new company. And I'm like, hey, nothing wrong with that at all. It's right as your life. It's how you want to be able to enjoy yourself. So we can say, all right, well, this is what my retirement will look like. We can start crafting based off of this. The areas that you feel good in, that's great. We can, keep everything the exact same. The areas that you feel less than stellar in, we can say, hey, what can we do as far as with our time? Because I believe happiness is tied to how you allocate your time. That if you spend your time on these things, you're going to feel good about them. If you don't spend your time on these things, then I find that you won't feel that good about them. And then we normally will then tie it up with your overall physical. So it's like two more. So we'll talk about your overall fitness and health. Yeah, so we normally talk about your fitness and health. Do you want to walk more? Do you feel pretty good about everything? What does that ultimately look like? And then the very last thing we'll talk about, which doesn't come up in retirement as much, but it does come up in retirement, and it is something that you do want to think about, and that is just how you feel as far as business. It's really messing up the S's today, right? Your business and career. There are people who want to work in retirement because they enjoy the relationships, they enjoy spending time with people, they enjoy being challenged, they have the skills that they want to be able to use, and they're like, I'm not using my skills. I have a very nice set of skills. Then it may make sense for you to find some way that you can give back in that aspect. All of us are different. And so we need to really spend a little bit of time understanding each of these aspects about ourselves. And when you know these things, like where you feel good, what you don't need to change, where you feel like maybe you have neglected that area, then we can contribute and we can work on having a retirement that and builds up on those parts. And then you're going to be sitting there and you're like, I feel good. Like I feel happy, I feel content, I feel joy. And it's not the money, it's what we do with our time. And I'll say that until I turn blue. The money comes and it goes. But I'm someone who believes your memories, your experiences, that's what lasts. That's what lasts forever. And that's how most, if you really look at it, that's how most religions will talk about death, right? It's like whether you go to a heaven or a nirvana or you're reincarnated, wherever you're going, for the most part, you get to take your memories with you, and you get some part of this self, this inner self. And I'm someone that believes that that is where we do need to focus a lot of our time. And I want to encourage you to make sure you spend some time on these things. Don't wait until the money is right. You can spend some time with the family. You can go and call people, even if it's once a month. You can spend time taking trips or going to concerts. You'll be surprised at how many sponsored kind of free events that you can go to, even if the money isn't there. But you'll just be surprised, even if it's once a quarter. Like you're thinking when you retire, oh, I could do it every single week. You probably could. But working, could we do it once a quarter? Could we do it once a year? We can still spend our time on these things. And so I do want to ultimately encourage you for that. All right, so then that's basically what would be the wealthy retirement system. These are the different phases that we would go through. We would go through each of the 5 steps. We would put the plan together. We check the numbers for sanity. We protect against the risk of the stock market and recession versus disability and key employees versus just, like death or life insurance. We put all the risk plans in place. Obviously, Uncle Sam with taxes. So we normally will allocate ourselves in a tax diversified manner. And then we start talking about what do we want to do at our time? What's the exit strategy look like? How's the business evaluations coming along? And even though this one was for a business, hopefully you're able to see that having the proper plan in place, you can do this even for yourself with your own plan. You go through those 5 steps. Where's my income streams? How are they going to be taxed? How much money do I need? How long will it take to get that? Could I wait an extra year and start getting some of the advantages of compounding interest? What are my contingency plans that if I get laid off early, or something happens where something happens to my spouse, something happens with my kids, all these things happen. Like life happens. Where a company, I had a client that they sold the company that they worked for was sold and acquired, and they just laid everybody off. And the person was like 61, and they're like, I don't know if I want to go through this grind again. Can I retire now? Went through the numbers and they were like, cool, I can retire now. Like, yes, you have the plan in place. You're ready for these, and you can do whatever you want. And so that's the goal for me. Tons of flexibility, enjoy yourself. Okay. All right. So then that is it today. Let me see if there are any comments. Eagles check. Hey, my friend, how are you? Doing good. I appreciate you always. Appreciate you being on. Appreciate you being on. Okay. All right, well, ladies and gentlemen, what I'll do then is this video will be out there, and then I'll try to clean it up. I'll always appreciate your time with me. And if you have any questions, just leave them in the comments, or you can message me. You can go to cityofwisdom.com/wealthy if you want. And then I will place, you can go to, and I'll place a link in the comments. We can go on my calendar. We can have a retirement readiness check, and we can just see how you're doing, and we can go through, answer some of these questions, and I can give you some guidance to set you up. Not exaggerating to say that any one of these conversations can save or make someone hundreds of thousands of dollars, because that's just the nature of what I do. There is some businesses that are hard to quantify the value. Mine is not one of them. My value is measured every single year, and so I like the pressure, but I also enjoy that reward. So as always, I'm thankful for our time together. You all are absolutely fantastic, and until next time, stay safe and enjoy life.